yesterday I had a question from somebody asking me, how did I know that Tesla was going to go up to a range of about 225 to 227? Well, that's called the expected move. Let me show you how to calculate that. So let's start by defining just what an expected move is to begin with. Well, first of all, we're back to the old normal distribution of pricing, right? So we have this normal distribution curve, and the distribution of prices are going to be generally around the mean, and the fat part of the curve here, the fat part of the bell curve, is going to be about 68%. So what you're going to see is the expected move is we're expecting the price to be within this bell curve here within a certain period of time. Now, what is that period of time? Well, that period of time is going to be whatever the expiration date is going to be. So in this case, the April 4 cycle is going to expire in 1 day. So there's only 1 day of time. What is the expected move? Where is the price expected to be after 1 day? And if you look carefully over here in Thinkorswim, this is where we can cheat. I'll show you the old school way to do this in a minute. But we can cheat, and they've actually listed the expected move right over here. And so what they're saying is that for tomorrow's expiration for the options, the spiders in this case are going to be plus minus about 1.37 points. So plus 1.37 up here, and then minus 1.37. Right, so about a 27-point range it's expected to be within between now and tomorrow's expiration. Now, when we log in tomorrow and this turns into 0, you know, Cinderella and the pumpkin, we're going to see that that range is going to be much smaller than a 27-point range. It's going to be something like this. So that's the expected move. Based on the open tomorrow, will be much smaller. And the further along in the day that we get, the more this is going to shrink. Now, conversely, we can go out to the June monthly expiration over here with 57 calendar days left, and we can see that the expected move is going to be plus minus 9.7. So 9.7 points, which is going to be, you know, plus 9.7. So that's a full 100 points on the full S&Ps. And then minus 97 over here. And so how does this tie back into Tesla? So what I did for Tesla was for the May cycle, when I entered this trade a couple of weeks ago, the May cycle of Tesla told me that had an expected move, which showed that the upper end of the 68% range was up at about 227. So what I did was I set up my trade around that area. I set up that out of the money vertical call spread around the 225 to 230 strikes. And if you know anything about the Greek gamma, what happens is gamma will actually peak out at those options, at the options that you buy and sell, right? So gamma peaks out at that. So what happens is that the value, well, by proxy, the value gets changed, but this pushes around delta near those strikes. And what happens is the value of the trade absolutely explodes as it gets near those options. So that's why these out-of-the-money options are cheap, but extremely explosive if you set them up right. Now, that doesn't mean that we should go out tomorrow and start buying out-of-the-money options. There is a very specific criteria and a very specific set of trading methodologies that we have around the whale trade. So we're looking for explosive stocks. We set these trades up at the expected move. So that answers the question, why did I set up the trade and expect it to move up to 227, and then by magic, there it is, leading us to 100% return. So that's the expected move. That's what it means. That's what it's all about. That's how to find it. Oh, now one more thing. I told you that I was going to show you the old school way of doing this. And let's do that. So the old school way of doing this is basically just to take the at-the-money straddle price. It is not as accurate as the reading that they have up here. But if we were to add the at-the-money, and right now at-the-money is about 210.5. So let's just take the 210, and what we're going to do is we're going to add 422 to 425, And we're going to get a value of about 8.5 points on that at the money straddle. So it's close, not quite as accurate as this reading that Thinkorswim uses. So if your broker does not have one of these tools that shows you what the expected move is for that option expiration, you can just cheat and add up the at the money straddle. So that's it for today's Market Minute. Thanks for listening, folks. We'll see you tomorrow.